The mortgage world is a different world, and today we have an expert in that arena. It's going to give us some insight, so stay tuned to this episode of The Den.
The Den, powered by the Lyons Group, a show that explores trending topics in real estate, entrepreneurship, and personal growth. We're a small team of professionals with over $400 million in sales and nearly 2,000 successful transactions. You're listening to time-tested experts and industry leaders. Here's a refreshing look at real estate happenings and more. Welcome to The Den.
Hello, everyone. Welcome to this episode of The Den. And today we're going to go deep on mortgages. What are the driving factors that really push mortgage rates? And some of the things that you should understand as a consumer when you're looking to get a mortgage and the overall environment. But before I get to that, let me introduce my friends, my partners, my co-hosts, the fellow members of the Lyons Group. And there's only one here today. Paul, Hammy the Rockberry, Aspen the Ninja Gruen, and Shannon the Boss. They're out of pocket. But we do have the fantastic, magical, mystical Mr. Peter Marthaler with us today, our preferred lender here at the Lyons Group. And he is an expert at all things mortgages. And of course, my name is Ben Mortgage Lyons, hosting this episode of The Den.
They're getting worse, Ben.
I know. And that kind of sounds like mortgage. It's like was that like a Thanksgiving leftover sandwich or?
I don't know. It's better than the mortgage geek.
Mortgage. Well, I can be a geek in a lot of things, but mortgages, I am not a geek in. And in fact, I call upon your expertise all the time, Mr. Marthaler. And when I have an issue, I'm like, oh my gosh, how is this going to play out? I'd probably ring you up more than you would care to.
You should ring me up more often.
Good answer.
Because I always want to help.
That's right. You do. Fantastic customer service, a true professional. You've been in mortgages now, 12 years?
You know, I was counting that on the way up here. I started my 13th year a week ago.
Wow. That's pretty incredible.
Yeah. Learned a lot over the years. I mean, people who do what I do, loan officers, originators, endless supply of information that even if you think you know, you still have to go back to the guidelines because guidelines change. Rules change, investor requirements change.
The shifting sands of the mortgage, of the mortgage world.
It's like making a plan in the sand.
That's right. If you want to get granular, you just call Pete and go, "Hey, man, we got to go deep on this one," and he'll go deep. He'll take you down there. Yeah. And then he'll pop up for air a little bit, and then he'll bring it right back down because that's where it matters. I mean, correct me if I'm wrong, Pete. In the mortgage world, you have conforming and you have non-conforming loans. Typically, you deal with only conforming loans. And can you give the audience just some thoughts of what a conforming loan is?
Conforming loan is traditional lending. Most people are familiar with Fannie Mae, Freddie Mac, FHA, VA, USDA. Those are all your traditional mortgage loans, if you will, financing vehicles. And then each one of those entities has an umbrella of different types of programs. Those are conforming. And then you get into the non-conforming or what's known as non-QM. A lot of the off the street that doesn't fit into the conforming world, like a non-warrantable condo or someone whose income is only earned from business bank statement deposits. Someone who deducts all their self-employment income down to a non-taxable income, and then we can use their bank statements and stuff like that. But the conforming world mortgages, 90% of the people out there are using them. You're normal consumer.
If you're a plumber, you just started your business, you're 1 year into, you got your first tax return, you're likely in a non-conforming position just because you don't have 2 years under your belt and you're still getting started. Is that, for the everyday Joe, is that an example that you could use?
On average, typically it's a 2-year tax return, self-employment income history, but we do have ways to make conforming loans work down to 12 months of self-employed income.
See, and this is where we get granular.
Yeah, I don't want to get too deep on just talking about generalizations and stuff like that. But then I do have a non-QM program where day one of a 1099 self-employed borrower, we can generate income from the new job.
That's incredible. And oftentimes, what are the biggest questions you get when you're at a barbecue?
Where are mortgage rates? What are mortgage rates today?
Exactly. What are mortgage rates today? Do you get that a lot, Paul?
Yeah.
Or do you usually get like how many?
How's the market doing? Is it a good year or a bad year? Is it a good time to buy or a bad time to buy?
Yeah.
Those types of things.
Yeah. And are you going to eat all that chicken?
Right.
That you put in? Loading up the plate of protein, Paul Berry. We actually had a fantastic podcast the other day. We talked about, we didn't get too far down the road, but we talked about, the Fed's cutting interest rates. And immediately for the consumers, correct me if I'm wrong, gentlemen, but immediately with the consumers, they think that the cut in the Fed's rate equates and correlates directly to mortgage rates going down. Pete, I'm going to give you this one. True or false?
False.
Okay. So when the Fed chair comes out and says, hey, world, we're going to lower interest rates on the federal level, the Federal Reserve, and people go, yay, mortgage rates are going down. You're saying that's not correct. And explain why to the everyday person.
So historically, if you want to go look at all of the times that the Fed has increased or decreased the Fed funds rate, mortgage interest rates don't always correlate. The way, because I get this question probably 9 or 10 times every week from consumers looking to say, well, back to what Paul was saying, is now a good time to be buying? Yes, is the answer. And we can cover that on another podcast or whatnot, or even today. But the Fed funds rate doesn't directly connect to mortgage interest rates. Let's put some baselines out there. Mortgage rates are long-term notes, 30-year, 20-year, 15-year, 10-year. Long-term notes have an underlying basis of two factors, the 10-year treasury bill and then your mortgage-backed securities or the coupons. So depending on where the 30-year rate is, mortgage rate is, it depends on the mortgage-backed security coupon that loan would fit into for a saleability factor. Keeping it simple, the Fed funds rate is short-term interest rates. The Fed funds rate is what banks lend money between banks, meaning the U.S. Federal Reserve and the Bank of Japan, the Bank of Canada, the Bank of England. That's the money that they lend between banks. And then you get into the prime rate, which is the Federal Reserve rate, plus the margin set for all underlying short-term notes. Everyone's probably got a credit card or an auto loan. Your auto loan or your credit card rate are based on the Fed plus the prime plus whatever your servicer's margin is. So the prime rate, whatever, 7.25. I'm not sure exactly where it's at, but it's going to be somewhere in that neighborhood. The margin above that is what the creditor's charging you for money that you're borrowing.
So what you're saying essentially is that if the Feds reduce the interest rates from bank to bank, right,
Mm-hmm.
then typically with credit cards, auto loans, and things like that, you may see a shift downward in that regard. Is that correct? Did I say that right?
Yes, you will see a shift. So anybody who has like a HELOC right now, when the Fed cuts the Fed funds rate by 25 basis points, which is 0.25%, your HELOC interest rate will go down exactly that amount.
Awesome. Yep.
Hi, I'm Paul Berry, a partner at the Lyons Group. We're dedicated to making your real estate experience the best it can be. If you're looking to buy or sell, go to sjcbroker.com and watch our informational video series. These videos break down the process of buying and selling. While you're there, schedule a private consultation with one of our partners. We'd love to sit down and talk strategy and give you a real advantage in today's market. You deserve the best, so take those steps, and we'll see you soon. Now back to the show.
Really trying to take it to the everyday person, that our credit cards, auto loans, maybe non-secured loans from, credit union or personal loan, those interest rates will directly correlate with the Fed's lowering interest rates altogether. But mortgages, there's a lot of different factors that play in. And you were saying something fascinating just the other day on how the interest rate was introduced at the podium drove interest rates, in your opinion, maybe one way or the other. Is that correct?
Anybody can just go onto Google and look at the charts. But if you look at the last 3 times that the Federal Reserve cut the Fed funds rate, mortgage rates actually 2 out of the 3, they went up. And the reason why, this is one of those baselines that we want to get back to, is mortgage interest rates today are forecasted for what's going to happen in 6 months. So today's rate is basically what the economy is going to be doing in 6 months. When the Federal Reserve got up there in September and then last week or a week and a half ago and said, we're cutting the interest rate 25 basis points. But then Federal Reserve Powell gets up in front of the podium and has these negative comments, kind of like concerns about the economy, even though the Fed funds rate went down. His hawkish comments scared that 6-month future forecast to where mortgage rates are now. So rates ticked up a little bit.
Wow, that's wild. I mean, isn't that wild, Paul? It's kind of like the stock market. You know, there's a financial component, obviously, in the stock market, but a lot of it's driven by emotions. I mean, how do people feel about what's going to happen with this company or that, or the evolution of technology or whatever?
What I've been talking about on past podcasts about mortgage rates are really based on the uncertainty of our economy. So when somebody gets up in a position of authority, says some negative comments, the world goes, we don't know what's going on. And I've been saying it about these tariffs all year. We're not we just had a podcast that we put out where we guessed what at the end of the year the rates would be. Everybody was a lot lower, and I was higher because I was like, I know that there's going to be some craziness going on in the economy. And that's where, so the mortgage rates pretty much I equate it to what the rest of the world thinks the strength of the U.S. economy is. That's kind of how I look at it in a broad sense.
Interesting.
That's actually a pretty accurate way to look at it, though, because like 6 months out, right? Mortgage rates today are what's the economy going to be doing in 6 months? So all of a sudden you have some negative, but then on the flip side of that, I mean, we could talk about this for weeks, but think about this. All of a sudden, some econ data comes out, like a CPI report or jobs report or JOLTS, or all these other econ data that gets released, and you see on the news, non-farm payrolls were below expectations. Well, if the labor market starts to deteriorate, mortgage rates typically improve because the Federal Reserve sees that forecasted certainty or uncertainty in the U.S. economy. Mortgage rates, I mean, no one really wants to say this, but this is a terrible thing, but in my industry, a recession benefits my industry because recessions drive mortgage rates down.
That's what I was just going to say. Let's dig into that a little bit. So when people hear about the job reports coming out, and if the job reports are negative, then what happens to the mortgage rates in your experience?
Mortgage rates go down.
They go down. So if there's a poor jobs report rating, then mortgage rates go down.
Typically they go down. I mean, every jobs report that comes out, there's a forecasted number that they think it's going to be. That forecast could be really, really low on a historical month over month or a year over year number. But if the jobs numbers actually come in below the forecast or above the forecast, it's all about the numbers and how much of a swing that it has that could move the mortgage rates in either direction.
That's pretty incredible. But for our everyday audience, what goes into the jobs report? I mean, is that just the amount of unemployed? Is it the unemployment rate, or what? Explain to us what's in the jobs report, Pete.
It's non-farm payrolls. It's basically a group of economists that gather data from households and whatnot, and they determine the number of jobs created, the number of jobs that were dissolved, and then they put together this number. I mean, that's really simple, layman's terms. I mean, I don't want to get too...
Well, you got to talk to Paul and I like that.
Yeah. So, I mean, if you think about non-farm payrolls, I mean, you're talking about industries like the service industry, the construction industry, the
manufacturing.
Right. All these different factors that go into what's the economy doing. So when you start to see the labor market deteriorating, the economy is starting to slow down or possibly deteriorate. Right now, what the Federal Reserve is trying to do is manage the Fed rate cuts to prevent the labor market from deteriorating too bad, but also to prevent the economy from growing too fast, the inflation battle.
Yeah.
It's kind of a double-edged sword that the Federal Reserve is working on right now.
Yeah. And wouldn't you see that as the problem, Paul? In our industry, is if we see a dramatic drop in interest rates. I mean, we saw the opposite of that in 2022. From January to November, you probably remember this all too well. They went from like 3.5 to 7.25.
Yeah.
So they went the opposite way. If we saw that today going from 6.5, 6.25 right now down to 3.5 or 4%, what would happen to our industry right now, Paul?
Well, there's a lot more buyers that can buy. So there'd be, it's an interesting, I hadn't really thought about it yet, but I would think because of low inventory, too many buyers, prices would shoot up.
Shoot up dramatically.
Yeah. So I think that would be, we don't want that.
Yeah. And so that's the double-edged sword you're talking about.
Because then nobody buys again. Everybody can, but nobody will because the prices are too high.
Yep. And so it just puts an incredible amount of demand on a lack of inventory that we're already facing in this industry. And so the feds are walking a slippery slope. I mean, it is a slippery slope across the board. Too much of a swing in one direction or the other. I imagine their push back in 2022 when the interest rates they more than doubled, was largely due to maybe putting a fire out with the housing market. Am I on pace there, Pete, or I'm way off base?
I don't know if I could speak to that, but I'll say this. It's common, well, I shouldn't say common knowledge. From my opinion, the Federal Reserve was well behind increasing the federal funds rate to slow down that increase in mortgage rates, housing affordability, just the year-over-year increase in home prices, the inflation, everything in cost of living, everything the Fed was behind. And that's what they're focused on right now, is not getting behind and trying to make up with short-term QE or whatever it may be. That's what they're doing right now. But long-term QE, that's what they've historically done to keep rates down. So, but yeah, I mean, I think back to what Paul was saying when we first started this talk, now is a good time to buy. And from my perspective, from the clients that I talk to, I'll talk to anywhere between 5 to 10 new leads a day, give or take the time of year. People always ask, well, rates are so high right now. Well, I understand, but home values aren't going to go backwards.
Mm-hmm.
I mean, they may flatten out, but your safest investment is always real estate. Because historically, if you look at home values, that graph chart goes from the bottom left to the top right, almost at a perfect 45-degree angle. There's going to be some bumps along the way, but interest rates go up and down just like the stock market does. So buy now, and trust me, those conforming loans, they're not going to let you buy a house that you can't afford.
Mm-hmm.
So the fact is that you want to marry the house and you want to date the rate. Because you can always refinance in the future.
That's right. That's right. And the number one wealth building vehicle in America is what, Paul Berry?
YouTube.
TikTok, actually.
No, real estate.
100%. And we had a great conversation about this the other day. It's like, when's the best time to buy? Whenever you're ready. Like when you've got your chips stacked,
Mm-hmm.
pull the trigger, because if the interest rates go down, now all of a sudden we're in a multiple offer situation again, and then it's driving home prices up. So I think it's Warren Buffett that said, when everyone's making hay, and it's heyday out there, that's when you need to be concerned. But when there's blood in the streets, that's when you go out and you start making your moves. And I think that's part of the season right now. So I don't know if he said it that exact way, but
be greedy when others are leery, and be leery when others are greedy.
Yeah, thank you.
You're welcome.
You are astute.
No.
Well, neither am I. So you're in good company here.
There we go.
Yeah. Paul, some follow-up questions for Pete that may help our audience. What are some questions you would think that an everyday person that wants to get some information from a mortgage professional like Pete?
Well, I would say, we always talk about the steps going into buying a home. We always see people putting the cart before the horse and looking at houses before they're financially ready or they've talked to a lender. So in your opinion, what's the very first thing somebody that's looking to either move or buy their first home? What's the first thing they should do?
Pick up the phone and call a lender. It doesn't cost anything to have information shared with you. Typically, your first-time home buyers are people who are thinking about buying a home or wanting to buy a new home or move up and move out of their current home. 50% of the hardest work is picking up the phone and just getting started. The rest of that process is all task management. It's just sharing information. It's simple.
Do you have a suggestion of where somebody should be in their financial stability before they start that process?
No, I don't have any starting point. I mean, think of it this way. I mean, I have clients who are fresh out of college and parents gave them $10,000 to go do what they want with it. They decided to buy a house. They're starting a brand new payroll job, W-2 job, and they got $10,000. As long as their income works, they can buy a house. I mean, if your question is regarding like reserves and savings and whatnot, you're either going to pay money in rent, which is paying somebody else's net worth and building their net worth, or you can do what you can because you're not going to be able to borrow money for a mortgage that you can't afford to pay back. The housing crisis is never going to happen again. There's rules and guidelines in place that will prevent that.
Yeah. When we did talk about that as well, I mean, is 2024-25 similar to 2008? And I think the clear consensus was absolutely not, because of the lending guidelines and restrictions that are placed upon you all now.
Well, hold on a second. Let's clear up the air really quick. The lenders weren't the only ones holding the smoking gun during the housing crisis. There was realtors and title companies and appraisers, but the lenders got the bad rap about it. Yes, because back then there was no compliance and regulatory law. Now there's a federal law. It's called the Dodd-Frank Act and the TRID. You guys are all too familiar with that. But
yeah, very much
on my side of the phone with the client, my responsibility to the client is to make sure that they meet the ATR rule, or ability to repay. So, I mean, that's a simple information sharing is free. Just pick up the phone and get started.
I love that. What do you think about people that go, yeah, but I want them to run my credit. You know, I get dinged on the credit. When fill in the audience on how that works and shed some thoughts on that.
Reviewing a credit report is part of the pre-approval. You got to have a minimum credit score to qualify for, depending on what type of loan. I mean, VA, there is no minimum credit score, but investors do have overlays. So typically the rule of thumb is 580. Can we go below 580? There are investors out there that will go down to 540 on an FHA loan. No, there's investors out there that no minimum credit score for a VA loan. But when it comes down to looking at a credit report, if your biggest concern is about a hard credit inquiry and you've been working on your credit, you're focused on your credit and your scores are going the right direction, but they're still not where you want them, I can still complete a pre-approval with a soft credit inquiry. The difference between a soft credit inquiry and a hard inquiry, a soft inquiry won't impact your credit scores. A hard inquiry could have an impact to your credit scores anywhere between 3 to 5 points more if your scores are lower. If your scores are really, really high, there may be zero impact if you haven't had any other inquiries to your credit within 12, 18, 24 months.
Yeah, that's a good point.
Call a lender and just get started, but make sure they can do a soft inquiry.
Yeah. I get people all the time that say, you know, I'm cleaning this stuff up. I want to get my things in a row. And I'm like, call Pete now. Call him now. Before you do anything else, call him now. Because what I love about your services and your company and you is you will take the time to look at someone's full picture and create a strategy tailored to them. And say, do this, don't do that. And it may be counterintuitive to a lot of people. They may be like, well, that's what I was planning on doing. You're telling me not to do that? No, hold off on doing that, but do this because it's going to get you in the best position to make an offer or, you know, get your pre-approval here within the next 30 days. Or sometimes it's 3 months or 6 months. You work with people for whatever it takes to get them to that position.
I build a pipeline pretty much one client a month for credit reviews is what we call them because we're not a licensed credit improvement agency and we can't do that. But I do have clients that one a month, usually on average, that I've been working with for either 3, 6, 9, 12, 24. I mean, I remember these 2 guys that moved here from Connecticut. They were in my pipeline and I followed up with them for 28 months.
Wow.
And they ended up buying a house because they needed some help on credit. And as long as they give me a response that you're doing stuff on your side of I keep following up with them until they tell me we're not doing anything or they don't reply. If credit's your focus, don't let that be the reason you don't get started, because that's what the lenders can do is they can help you, give you a roadmap. And I always like to tell my clients, it's not my job to tell you yes or no, but it's to tell you, yes, here's how, or but if not now, then how and when. So, and that information is powerful because people don't know what to expect. Back to that phone call. Pick up the phone and just make the call.
Yeah.
That's the hardest part.
Yeah. It's like going to the dentist, right? The hard part is just walking through the door. And then once you're there, it's like,
No. It's when they have that drill in the back and you're.
Yeah.
Or going to the gym.
You
think, I got to go to the gym.
But once you get there, you're just like, I start touching stuff.
You feel fantastic.
One of the big things that we're seeing now is people getting into these deals and the lenders say, yes, you can. And then it's the sticker shock of that monthly payment. And as soon as you put in, because interest rates are going up, and not interest rates, insurance premiums are going up. Mm-hmm. Taxes, of course, always, well, they never go down, just like home values. So once you get that principal and interest estimate, then you put your insurance and your taxes on it, then people are going, whoa. A lot of the fall throughs that I've been seeing are because of sticker shock on the monthly payments. Are you seeing that at all?
No, because part of the process that I go through with my clients is that before I turn them back over to the home shopping avenues, they have a really good idea of what a housing payment's going to be.
That's why it's good to go to you first.
That's why it's always good to go to a lender first. I mean, because think of it this way, going and looking at a house, you don't know if you can afford it. And even if you could afford it, depending on all the variables that go into what you're wanting to do as your goals, your budgets, your plans, that payment could be a sticker shock payment.
Yeah.
You could be like over your skis a little bit. Like, that's when you kind of, oh, hold on a second. Well, that's the information that's free. Doesn't cost anybody anything to have information shared with them completing the pre-approval process.
It's well said. How about programs nowadays for people? We used to use USDA quite a bit. We don't use it as much anymore for some reason. Maybe I just haven't had the buyers in that scenario. And with the USDA, if you buy outside of a municipality, you have the availability to get a USDA product, which is basically a zero down loan program. And then in some instances, you can have the seller contribute and cover your closing costs. So you can get into a home with a relatively small amount out of pocket. Can you expand on that? Maybe an MFA program a little bit, Pete?
Yeah, USDA is obviously the United States Department of Agriculture. Basically, what these mortgages were set up for is the farmers outside of the municipalities to be able to afford a house, and they didn't have to come in with a down payment. It's a government-insured loan, so interest rates are typically below the average conforming Fannie Mae, Freddie Mac, or whatever traditional loan. But with the U.S. government insurance, lenders can offer a lower interest rate because they have that government backing and that insurance. On a USDA loan, again, yeah, you're absolutely right. The property specific the property address has to be specific to the USDA geographical approved area. In regard to that financing, you may not be seeing a whole lot of them because the USDA guidelines, which is part of the pre-approval process, are a little bit more restrictive than, say, like an FHA loan. I'll give you one example. On a USDA loan, the maximum back-end debt-to-income ratio could be 43% or 45% if you have a automated approval. With an FHA loan, the back-end debt-to-income ratio could be 56.99. So there's a lot more on a monthly liability, whereas USDA is such a great loan, the USDA makes it a little bit more restrictive to qualify for the loan, so that way the insurance of making that mortgage payment's there. You're not becoming house poor, if you will.
Understood.
In this area, most of the homes outside of the municipality, even though geographically they would qualify for USDA, the homes don't because they're manufactured. You can't. USDA is not doing. They're doing new sets, but not.
Yeah,
resales.
USDA will only lend on a brand new manufactured home, never occupied.
Yep.
Yeah. So there are absolute restrictions. Paul, we have one more. We have time for one more question. Then I've got a follow-up question for Pete at the end.
Oh, go do your first one, I guess, because I'm not ready.
No, you are ready. Come on.
Ready?
Yeah, you're ready. He wants to ask you this.
Veteran borrowers.
Veteran.
Sure.
Yep.
Talk about a VA loan.
Yeah, well, I mean, I know that some of us in this room are veterans and somebody isn't.
Some of us are slouchers.
So thank you for your service, Paul.
Thank you for your service.
You're welcome. VA loans, I mean, we do, that's probably our bread and butter. I mean, yeah, VA loans are fantastic. I think the biggest thing that people don't realize on a VA loan, that somewhat recent changes over the past couple of years, but you can use your VA home loan benefits to buy any price of a house with no down payment. because a long time ago, once you went over that conforming loan limit, the VA had a component of down payment that you had to come in with. But now the Blue Water Act a few years ago wiped that out. And people can use a VA loan to buy a $2 million house with no money out of pocket.
And the eligibility changed a little bit too, didn't it?
In what regard?
The two
yes, that's the other
primary homes.
Well, you can't have two primary homes, but you can have up to two VA loans.
Right.
So think of it this way. The way that the VA works is it's focused on the veteran. The veteran, and they're always going to err on side of the veteran. So if the veteran's stationed in Norfolk, Virginia, and they buy a house, but all of a sudden 4 years, 5 years later, they get new orders and they end up in San Diego. Well, they want to buy a house there. Rather than having to refinance or sell that house, they can keep that house and they can get another second VA loan. There's a basic entitlement. That's with the single VA, but then there's also bonus entitlement. So back to where any purchase price of a home, no down payment, that works on the first one. Now we're back to that whole bonus entitlement and having a component of down payment on the second one, depending on the home price and how much basic entitlement's left over for the veteran. But you can have two VA home loans, but you have to occupy the house as your primary when you buy it.
Love it.
Yep.
VA is a fantastic loan.
It's amazing loan.
So grateful that we have carved that path out for our veterans, those that have served our country and served well. I do have one final question before we wrap it up, Pete. You did hear that episode where we gave our best guesses on the mortgage interest rates. So for 1 year from now, we're going to put you in the pile now. There was all of the partners here at
it's a lunch. You have to buy a lunch for the winner.
The loser buys lunch for everybody. Okay.
Deal.
So if we project ourselves 1 year in advance, and actually it's going to be right at the end of 2026, we're going to take the Freddie Mac average of that day, the interest rate. Whoever's closest wins. Who's ever furthest away is buying lunch. What's your best guess 1 year from now where interest rates will be?
5.875.
Wow. Where'd you end up landing?
585.
585. Okay. I had to go 567. I mean,
well, I don't want to. There's all kinds of data out there.
Now.
Just wondering who you want to go read and what you want to look at. But yeah.
So you're pretty optimistic.
I am because of the way that the labor market's right now moving. Unemployment ticked up. Job losses ticked up. We got some big reports coming out in the next couple of weeks. So we'll see what happens.
And I was there because I thought, the economy these tariffs will have had 2 years to get everybody to get used to them. Everything will start to level out. So I think, things will get a little bit better.
See, look at both you guys on logic, and I'm just over here trying to do 6-7. I mean, I just
7. Yeah. You have 2 daughters.
Oh my,
teenagers.
A couple teenagers. Well, you heard it here at the Den. Mr. Peter Marthaler with Housed Loans. Thank you for coming and joining us today. Fantastic and in-depth conversation on the mortgage world. Sharing a little bit of your knowledge. You have a lot more knowledge to share. I mean, we could eat up a lot of podcasts. But if you are looking to get a mortgage loan, we're going to put Pete's information in the detail in the comments section of this podcast. So you can get right a hold of Pete, and you originate a tremendous amount of loans, especially here locally, and have been our go-to for a lot of years, primarily because you take care of people and he cares about people. And he does the best he can to create a path and strategy for a win. And we love that about you, Pete. Thank you for coming on to this episode of The Den.
Thanks for the opportunity.
Yep, absolutely. And if you like our content, please like and subscribe to our YouTube channel. You can go to our Facebook page, which we have a fantastic newsletter that Paul sends out every week, gives you all kinds of great information. Of course, you can go to sjcbroker.com and schedule a private consultation with any member of the Lyons Group. We'd love to sit down with you, whether you're buying or selling residential or commercial. We can give you an advantage in today's market. So thank you for listening to this episode of The Den. Until next time, we'll see you then.
Thank you for listening to this episode of The Den, powered by the Lyons Group. Hit the subscribe button to keep informed and check the show notes below for direct links to our buyer and seller video series. The buyer and seller video series can give you an inside track on taking the right steps in real estate. If you'd like to learn more about the Lyons Group or to schedule a consultation, go to sjcbroker.com. Complex markets require complex strategies. The Lyons Group can give you a true advantage in any market. Whether you're buying or selling, residential or commercial, contact us directly at sjcbroker.com. We're time-tested experts with a client-first approach, and we'll see you next time in the den.